Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets and what we're looking at. As always, don't use these videos for trading purposes. They are for information only, just a review of what we're seeing in the markets. As we look here, this is the weekly chart of the S&P 500 going back to late 2020 here on the left side. So we're getting about looks like 6 years here. You see the nice uptrend we've had. Certainly 25, we had a awfully nice pullback here into April, but have since bounced right back, and we're at all-time highs. So once again, we did break that trend line, get very defensive, but looked for some spots that we thought the market would hold. It did. And now we're back in all-time highs again. So trend line underneath here, looking, and I always put in support here. I'd really want the market to hold this level right around 5,700 if we were going to be moving on to new highs, or if this isn't just something to sort of suck people in and we're moving the other way. So those are kind of the points that I'm looking at there on the long term. But yeah, we're in a full bull market again. We come down here, look in a little more detail. This is the daily chart. So right here, you see this gives us about the last 2 years trading, and there's the trend that we're looking at. We're above all our major moving averages, the 200 and the 50-day. So everything's looking good. Put in again a little resistance. In the short term, I'd want just the market to hold this above the 60-50 or so, maybe 6,000, for us to say yes, this is going to be a uptrend moving on to all-time highs and staying there. But everything from the long-term charts, the weekly charts, the daily charts, everything is up, and I'm not seeing anything that's really damaging at the moment. We go to a little shorter detail here. This is a 2-hour chart. This gives us about the last 6 months of trading. Tend to put a trend channel on here, give the market room it'll digest, have a little off day, what have you. It's not going to just be a straight up or straight down ever, but it makes its way. And you can see that detail here as we're just running up in a little channel, and maybe it comes down to test the bottom of it and moves on again. But also here, nothing to see. So of all the price charts that we're looking at here, there's nothing to be concerned about at the moment. If we look at some of the breadth measures, let's go down and look at that. This one here is the percentage of the S&P 500 that's in an uptrend, and currently that's 75%. It's a good number. Sometimes you'll see false rallies where it's just a couple of stocks, the Nvidia, that kind of thing, Facebook, Google, that are holding the market up while the rest of the market's really struggling. But right now we've got 75% in an uptrend, so that's a fair number. Below that here is the advanced decline line on the New York Stock Exchange, and that is heading up as well. So again, from the breadth measures, the internals, things look good. And finally, the VIX, the volatility index, this would indicate that people were paying up for insurance on protective puts on the market. They'd buy options contracts that would protect them as the market falls. You'll see it spike, as you did here in April, get up to 52 when that insurance premium becomes very expensive as the market is selling off. And so right now the VIX is low. Everything that we're seeing here is nothing to worry about at the moment. Of course, in markets, things can change, and they can change rather quickly. But right now, not seeing that, so we try not to go defensive or something like that when the market's not telling us to. We just are paying close attention. Look in a little more detail at, we started this in recent videos to look at some of the other things inside the market that might give us an indication of what's going on here. This chart is the ratio of consumer discretionary stocks. So things that you might buy that clothing or hotels or what have you, if you had spare money, and it's against the ratio of consumer staples, things that you would always buy, like deodorant and toothpaste and food. And so when that ratio is going higher, it's the market betting that people don't think that there's some dire recession right around the corner. And as you can see, that's been heading up here. Same thing with technology stocks versus utility stocks. Utility stocks are going to do much better in a bear market, in a problem market, and right now tech stocks are doing quite a bit better than utility stocks, as you can see. Same thing, biotech versus healthcare. It's basically just a game of conservative against aggressive, and all of these are headed up. The final one is the hotels versus utilities. Obviously, you would expect hotels to not do well in a pullback, and you would expect utilities. People are still going to need to have electricity and heat their homes. So everything here is telling us, okay, the market is not. There's nothing inside of these things that's telling us there's a problem. Finally, we go here to, I want to look at interest rates. This is the interest rate on the 10-year U.S. Treasury, is a benchmark interest rate for the U.S. And it's just, as I've shown in prior videos, it just keeps staying right in this 4% range. We're at 4.4. It bounces back from time to time and different, but it's really staying between 3.8 and 4.8. So again, pretty flat there. Nothing that's going to get the market considering that there's a big change coming or something like that. We've had relatively steady interest rates here. If we go and look at the economic picture, go over here, trading economics and the GDP growth rate. So this is the last, that's the previous. So the last reading was negative, but you can get a quarter of that. It's not the end of the world, that is, and it's been a little while. We haven't had the quarterly out in a bit, so still it's fine. There's nothing screaming at us that there's a big problem. In terms of payrolls, 147,000 on the last number, about the same as 144, the one before that. Those are fine, but they're not great numbers. It's not that the job market is really growing, but it's also not selling off or terrible either. Inflation, fairly steady around the mid twos. And then I like to look here at retail sales. That's not a great trend. That's starting to slow a bit. I don't really love that right there, but nothing to show that we've had terrible issue yet, and there may be some change in consumer behavior around some of these tariffs or anything like that. So it could be some of that shaking out, but just the economic picture, not as great as I like the sort of technical picture and what's going on inside the market. Finally, if we go to valuation, you can see here this top line 43.33. That's where the market would be trading if it was about 20 times reported earnings, and it is way above that. So we're back into we had been expensive all year. The pullback during April had got us closer to where it wasn't, but we're right back into all-time highs. So again, the market is quite expensive. So something for us to be a little bit concerned about. So finally, I'm going to put up, I hope this is informative and helpful. I'm going to put up our contact information here. If you should want to hear about what we're doing for clients, talk to us about our portfolios, please don't hesitate to reach out. Otherwise, hope this was helpful and informative, and we'll see you at the next update. Thanks so much for watching.